Now we reach the next topic, reversals. We previously mentioned that we have two kinds of market behavior, a trending and a ranging market. Sometimes it's hard to identify the direction of the market, or it feels like the price has been trapped in a box. The subject of the ranging market is out of the scope of this video, so let's focus on when an uptrend turns into a downtrend and vice versa, or, in essence, when should our overall bias be bullish or bearish? As we mentioned earlier, the break of an origin creates a change of character. A breakout occurs when a candlestick closes a visible amount through a level of market structure. So, first we must locate the sources to identify the reversal points. But here is an important point. Scales matter in identifying the change of character. For instance, here, both of these levels are considered a source because they have broken above the previous market structure. However, we won't consider this break a valid change of character. The reason is that the failure of such a small movement is not supposed to be considered a reversal of the trend. So here is another rule for a change of character. A valid change of character occurs by breaking below the lowest point of the latest impulsive move that is at least half the size of the previous one. For example, look at this chart. If we apply the concepts of market structure, we would have three impulsive moves like this. All of them have created a new high, so breaking below the source of each one is considered a change of character. But look at the size of the third impulse. It's barely even half of the previous move. So in this case, if the price breaks below the swing low, we won't consider that as a valid change of character. So basically, we compare the scale of the latest impulsive movement with the previous one, and it should be at least half the size to consider it a valid reversal. So if the previous move is 40 pips, the latest impulse must be at least 20 or else we have no valid change of character. Here, in the bearish scenario, these are our impulsive bearish movements. Breaking above this is considered a valid change of character because this impulsive movement is obviously larger than half the previous one. Keep in mind that we always compare the latest impulse with the previous one on the chart. No matter what your entry strategy is, trading along with the dominant market direction will instantly improve your win rates and risk-to-reward ratio. But remember, before using any setup with your real account, you should backtest it on different pairs to evaluate the trading strategy's performance using historical data. We do plenty of backtesting as well, but unfortunately, it takes a lot of time. That's why we recommend TraderEdge. Step: we use the TraderEdge platform for backtesting our exclusive trading strategies. If you're interested in using TraderEdge as your backtesting tool, be sure to check out the link in the description below. Now, one of the most critical concepts in identifying the trends and reversal points on the chart is liquidity. Talking about liquidity, generally, there is liquidity above the top and below the bottom if we consider this as the market structure. The price has more tendency to grab the liquidity below the recent low and then continue pushing higher to grab the liquidity above the recent high. But most of the time, liquidity is used for trend continuation. This means that in a bullish market, we usually witness the price sweeping the liquidity below the lows to gather the fuel for upward movements. Candlestick formations are important in identifying liquidity sweep movement. In the bullish scenario, a long wick at the bottom of the candlestick represents a liquidity grab movement. Imagine if this area is our previous support, so we have lots of buy orders gathered here, which means that the stops are somewhere below this level. So, a long wick breaking through this area is considered a liquidity grab, but only if it won't have a long wick at the top as well. This would be a great sign that the price can start its movement to the upside. It is not possible to define a mechanical structure for all cases, but what we want to see is a wick penetrated through the level and quickly returned. However, this wick should be at least half the size of the body. Now, we have mentioned previously that for a reversal, a source must be broken. But here is an important point. When we combine the liquidity concepts with market structure, a liquidity sweep above the higher high is also considered a sign of possible reversal. For example, here we have the recent source that has broken the market structure to the upside. When price sweeps the liquidity above the recent higher high and fails to create a new high, this is considered a sign of possible reversal. Liquidity sweep against the dominant trend is very different from liquidity sweep in the direction of the trend, meaning that grabbing the liquidity above a high represents a temporary reversal, but we do not expect the price to drop much. A true reversal is confirmed when the price breaks and closes below the most recent origin point. Then, we can confirm that the uptrend is truly over, and the price can continue pushing lower. The same concept is true for the bearish scenario. Sweeping the liquidity below the latest low indicates a possible short-term reversal for the dominant downtrend. From the price action view, the sellers have failed to create a new low, which shows momentum loss. When the price immediately gets back inside the range, it indicates upward momentum, which has the ability to push the price to the supply level in front of the price. And if the price breaks above the origin point, the reversal is confirmed, and we have a change of character. Here, we have gold in the 5-minute chart. The market sentiment is bullish, and the market continuously makes higher highs and higher lows. These equal lows are the source of the break of structure movement and contain lots of liquidity. Therefore, a liquidity sweep pattern formation at this level serves as a strong upward continuation signal. On the contrary, forming a liquidity sweep pattern above the high signals that a temporary reversal is coming. This reversal is later confirmed by breaking below the recent source point that has led to a break of structure. Then, we can expect the price to change the direction and possibly continue pushing downwards. Practicing these concepts on your chart will definitely improve your chart analysis, help you understand the fundamentals of price movements, and optimize your trade entries. So guys, I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support, and if you're new here, consider subscribing to our channel. See you in the next episode.